Good afternoon. This is Greg Kojak. It's afternoon here in Chicago. It's Wednesday the 22nd, 2018. Webinar that I'm going to record in an effort to try to give an overall update on markets, economy, and some of the things that we're seeing in the investment world. Also because I think a lot of people have a hard time setting aside work time to join us on these webinars. So this is my first go at it, so here we go. I'm going to break it down into basically like three categories: market valuations, the economy on a corporate level, on a consumer level, and then also looking at like the Federal Reserve and some of those Federal Open Market Committee projections, and also investments in relation to things like bonds and stocks and commodities related to inflation as well. So I think there's going to be about 15 slides or so, and I'm going to try to get it through the material, the data pretty quickly, hopefully in about 20 minutes. So that's the expected timetable, but never know, it might run a little longer than that. So the first thing I want to point out is I have a series of slides here, and this one on the left-hand side is data from December 31st, 2017, so at the end of 2017, the beginning of 2018, and also here on the right is live data, so July 31st, 2018. So a lot of the financial media is reporting on all-time highs. How much further can it go? You know, is there going to be a correction? It's important to keep in mind what the markets are, how they're valued, and relative to history as well. So here on the left, December 31st, 2017, the S&P 500, the 500 largest companies in America, had a PE ratio, so PE, price divided by earnings, of 18.2. What does that really mean? Well, we have to go back and look historically, but also on a back in time as well. So at the peak of kind of that pre-correction bubble, the real estate bubble, so October 9, 2007, the P ratio is 15.7 on the same 500 companies in America. Here we are, 18.2. And then going back to the tech bubble, March of 2000, the P ratio is 27.2. So here we are now. This is current data over here on the right, July 31st, 2018, P ratio of 16.5. So it actually went down. I also want to quickly just fast forward and show you this as well. So the 25-year average on the S&P 500, that P ratio is 16.1. And again, here we are at 16.5. So when we look at this and we kind of compare it historically, the P ratio dropped. And so the valuations are more attractive than they were just 7 months ago, and even though the markets are higher. And a lot of people are asking, well, how can that be and how does that work? So P ratio, price divided by earnings, we did have a little bit of a pullback in the S&P 500. I think that was the very first week of February or so. But on top of that, we had the Tax Reform Act. And one of the largest pieces of that legislation was the corporate tax rate dropped from 35% to 21%. That is a massive change and decrease in overall corporate taxes. So when corporations have lower tax rates, they retain higher earnings. So the E is growing in the PE ratio. So, and the price came down slightly. We saw between January 1st, July 31st, 2018. So even though the markets are even higher than they were from the bottom, here's the very bottom of 2009, the S&P is up 316% since that time frame. They're still relatively fairly valued, not necessarily overvalued. They were probably a little bit overvalued here, but again, this was pre-Tax Reform Act. And again, looking historically, the P ratio at the height of the real estate market pre-recession is 15.7, and so by this metric, we're still just slightly ahead of that mark. But again, a lot of people think that the recession happened because of the all-time highs in the stock market, that's just not true. Stocks actually were undervalued historically at that time. It had to do with the financial crisis, with bad loans being made and disseminated throughout the financial system. And then again, looking at the tech bubble, this was definitely an overvaluation in a bubble at 27.2. So here we are, 16.5, relatively valued, fair valued, I would call it. So you're not buying any of these companies, the S&P 500 in general, on a discount as you were going back all the way here. So you are paying approximately market value for these companies. Okay, so then I want to jump ahead to corporate earnings. Obviously, one of the biggest components of markets and returns in company stocks is earnings. So here's the S&P 500 earnings per share. We can see that they've been steadily growing since kind of a little bit of a drop here in 2015. They've been steadily growing. The light green are projections and estimates by analysts. So we do see that going into the end of 2018 and 19, that corporate earnings, earnings per share, EPS, are going to continue to keep growing, which is encouraging. And then here on the profit margin side, the S&P 500, again, looking at what percentage of profits these companies are earning, you can see that they're also at all-time highs at 11.7. And again, they've been in this 8 to 10 range roughly since about 2011 and 12, and then it picked up since about mid-2017. So on the corporate side, things are looking good. Earnings per share are coming through. The analysts are coming through and looking at it in a positive light. Profit margins are all-time high for these S&P 500 companies. Things are looking pretty good. Okay. So the next thing we can do is kind of jump forward to different, I'll call them, categories of stocks. So again, I'm going to flip between my slides from December 31st, 2017 on the left, and then over here, live data, July 31st, 2018 on the right. So what we can see, this was pre-Tax Reform Act when we did see that higher P ratio on the S&P at 18. Here it is, 18. This slide will show me current P ratio divided by the 15-year average. And so when you divide the two, you can kind of see how the valuations are coming in higher or lower than the 15-year average. And going back to December 31st, these were pretty rich, as you can see. Definitely each category between the large companies, the mid-sized companies, and the small companies were all coming in. And you have over time. We've got the data, and these valuations have come down considerably, somewhere in the range of between 20% and in some cases a little bit more. But again, going back to the point that here on the U.S. side, in terms of stocks between the large, mid, and smalls, it looks like small value is really kind of the only one left that's coming in below its, and this side is a 20-year average. So it's coming in below its 20-year average at 97.2. So this category, small value, looks attractive from a valuation standpoint, just a simple valuation. And if just to point out, small growth, where we've seen some of the most return in all of these different categories. These are mainly tech companies, biotech companies, and so we're seeing some valuations that are a little bit high, but still coming down from that December 31st, 2017 average. So something to consider and keep in mind that we will never probably exit out of any one of these asset classes or categories completely. And so, but we will, drift to one side or the other. We have seen more return on the growth side all three, the large, mid, and small growth, mainly due to tech and the expansion and that type of thing. So the performance has definitely come from the growth side. Okay, so next, I'm going to jump over to declines in the market and what historically has happened, just to keep it in perspective. So this chart will show the S&P 500 intra-year declines versus calendar year returns. Essentially, it's going back to about 1980, and it's showing us that each and every year, if you simply bought the S&P 500, the 500 largest companies, held between January 1st and still held December 31st, these would show you the years that and how much positive return you earned. So, for instance, in 2010, if you held the whole time, you earned a positive 13% return for that particular year, for that particular time frame. But you had to endure a minus 16% drop in 2010. So during the course of the year, at some point, the S&P fell 16% and then rallied and came all the way back to end on a positive 13% note. So going back, historically, we can look to see over the past 38 years, 29 have been positive returning years. And just to keep it in perspective, to buy and hold essentially. But when you average the intra-year drops, they come in at about 13.8%. And we really haven't seen any sort of intra-year drop like that for quite a few years. Going back, this is probably going to be about 2012 when we saw minus 19 on the S&P. So you can see that we've had close ones, but I think a lot of people have been a little too comfortable and getting used to low volatility when it was probably an unusual sort of a time period in our post-recession recovery where markets were constantly producing returns with low volatility. And just to keep in perspective, that historically has not been the case. Okay. Next, I think I'm going to jump over to the economy. So our economy is based off of a number of factors. We have, actually, you know what? I'm going to go back to corrections here. One more thing to point out. So when you do hear things like the market will correct, it's coming, it's important to keep into context what's happening in our economy and what historically have been some of the macro factors in play during previous corrections, so that way we can identify them and see if they're currently in place as we go forward. So here is the slide that shows the 10 most recent market corrections and kind of the time period, the duration that it lasted on the bear market side as well as the bull market side. But I just want to focus on the macro side, the macro environment. And so this slide will point out four major factors that were present or not present during those 10 market corrections. And so there could have been a recession. So if you look here in this column, a recession was present 8 out of the 10 times for the 10 most recent market corrections. Commodity spike, meaning commodity prices were starting to jump and commodities were becoming expensive. That happened 4 out of 10 times. An aggressive Fed that was either raising or lowering interest rates, that was prevalent 4 out of 10 times. And extreme valuations, which is, very high PE ratios like we were talking about at the very beginning, was present 5 out of 10 times. And so a lot of people have the notion that market corrections happen because markets are at all-time highs, things are expensive. That's not always the case. And so using all this data, we can now look at the current cycle here. So our current bull market cycle started March 2009. We're going on 112 months of bull market returns. But let's take a look at the factors. There's currently no recession in the U.S. economy. there's no commodity spike. There is no aggressive Fed, and there are no extreme valuations at this time. And so we have to kind of look at this objectively and say, not to say that it can't happen, but some of these factors that historically have been in play, if you look, sometimes, one or two were in play, sometimes three. So this was the tech crash of 1970. There was a recession, a commodity spike, and an aggressive Fed. So in the current cycle, we have none. They're not present at this time. But again, things in the economy could develop quickly, and we could see one or two or three even, or all of them pop up. Kind of depends on what happens going forward, and we just have to watch it and pay attention to these factors. Okay, so now I'm going to fast forward, jump over to the consumer, on the consumer side. So here, consumer finances. So this is the first quarter of 2018, the consumer balance sheet. So this is total assets. So between homes, tangible assets, deposits, pension funds, which are mostly retirement-based, and other financial assets, here it comes to $116 trillion. On this side, it's going to show us liabilities. And so you can see just on a visual basis, liabilities are much, much lower than total assets. And a lot of it is, of the total liabilities, 67% are mortgages, which are mostly locked and fixed at this point. And so, but we've got auto loans, student debt at 10%. So there are other liabilities out there that the consumer is shouldering. But I also want to point out this. So at the height of the pre-recession, the fourth quarter of 2007, the household debt service ratio on average for the consumer is 13.2%. That was the highest that it's ever been going back to the 80s. Since then, obviously, with deleveraging and the markets coming down, much more manageable household debt service ratio, and it's down to 10.3. It's really been in this 10 range since this looks like probably about 2011. So consumers are treating debt much more careful probably about debt and holding it steady in this range, which is good. Okay, next, unemployment. Jump over to unemployment rate. This slide will show us by education level, which is kind of interesting. So the unemployment rate for less than high school degree is the greatest, and no surprise here that post-recession got it very, very high, almost touched 16%, and then steadily has been decreasing since then. And obviously, the higher your education level, the lower the unemployment rate is for that particular category. So when you average all these together, it's coming in at let's see, where's that? It's coming in right at about 4% right here. And just to keep it in context, the 50-year average unemployment rate is 6.2. So we're well below that. I thought this was interesting, so I'll point it out. This is my slide on the Federal Open Market Committee, the Fed, and what their projections are and estimates, and also taking a look at what they think for the short term, 2018, 19, 20, as well as the long run. So change in real GDP, they project a higher and stronger GDP in the end of this year, slightly slower and lower a little bit in 2019 and kind of tailing off in the long run. They think it'll be about 1.8. Unemployment rate, this is interesting. So, currently it's 3.6 is the overall national unemployment rate. They think it'll go down just slightly over the next couple of years, but the long run, they want it to be at 4.5. So a lot of us will probably scratch our head and wonder, why is that? Why would the Federal Reserve want a higher unemployment rate on a national average than what it is currently? And The answer, I believe, is wage growth. So we've heard a lot of talk about wage growth, and wage growth is stagnant, not growing. And I guess the consensus is that if you have more people unemployed, they are all kind of they're fighting for and competing for the same jobs, and so that actually should spur on wage growth. The reality, though, when I did it, and just back of the napkin math, so this is a full 1% increase in unemployment. And if you multiply that by the labor market here in the United States, it's about 1 million people. So the Fed is looking at having about 1 million people unemployed, more unemployed than currently are, in an effort to get wage growth spurred and kind of trending in an upwards direction. On the inflation side, the Fed is really pretty aggressive, I think, and focused on keeping inflation under control. So you can see their projections are for 2018, 19, 20 about 2.1, with a long run of about 2.0. So they're very focused on that to keep inflation where it is. I've used this example quite a bit, and I think people have heard me use it as well. So what's happening right now in the economy is, and I hear this from all sorts of clients and corporate recruiters and all sorts of people that kind of work in the employment space, which is we can't find enough qualified people to fill all the jobs that we have. We have openings at our companies. We just can't find the right people. And when they do come, they are asking for a lot of additional perks. So the example that I use is, let's say I'm a business owner and I have 100 desks in my company and 95 of them are filled. And I've got, increasingly over the years, I've hired more and more people, so my earnings are increasing, my profits are probably increasing as well. But I'm having trouble filling those last 5 desks. And let's say I pay all of my employees $75,000 a year with 3 weeks paid vacation, just as an example. So when a qualified person is, and we're interviewing to fill those last 5 spots, what's happening is these people are being competed against, or they're trying to be acquired by companies, and they are, essentially using that as a way to get what they demand, essentially, if not more. So when this qualified person comes to me and says, Greg, I'd like to work at your company, I'll say, sure, I'm interested, let's talk, and I pay $75,000, 3 weeks vacation, yada, yada. And so the person will say, well, that's great, but I just want to let you know that your competitor across the street is going to pay me $80,000 a year and give me 4 weeks paid vacation. Can you do better than that, right? So you've got this scenario where these last few people that are coming in on the tail end are demanding more because there's such a scarcity, right? At 3.8% unemployment, there's just not enough people out there to try to get more that you actually need or are qualified for to work at your particular company. And so when you have these last people and they are essentially asking for more and more compensation, more benefits, more perks, and I didn't factor that in as a company owner, then what do I have to do to my prices to make up the difference? Well, I have to increase my prices, right? Because if the last couple people, I have to pay them $5,000 or $10,000 more each, right? I have to increase my prices. When you increase your prices, that's inflation. And this is a common theme across the entire United States, almost broad-based across industries as well, and not even geographically, but almost, across the entire United States broadly. So that is how inflation starts to pick up in the economy. And again, one of the factors and one of the ways that the Fed can mitigate that is through raising rates. And so the Fed rates is what they control. When they raise those rates, that's the rate that banks used to lend out money, so small business loans, auto loans, other sort of consumer debt that can be issued by a bank. So when interest rates go up, borrowing money becomes more expensive. And when it becomes more expensive, fewer people are taking out loans, right? So as a business owner, it may be a little too expensive to take out a loan to add a second office or build a new department. And so, but that doesn't mean that these business owners are necessarily laying off people and firing them. It just means that maybe on the earnings side, the earnings are starting to plateau and they're not really going much higher because you don't have any more people that you can hire. So your earnings are going to plateau. Your profits are probably going to stay in a range that doesn't move all that much. But again, that doesn't signal that there's a recession and I have to lay people off. It just means that we're probably at the tail end of this economic expansion, right? Which is based on people and employees working and contributing and producing earnings, which turn into profits. So anyway, that was just kind of my example for inflation and also, being at the end of this economic expansion. Okay, so jumping over to, I'm going to touch on bonds, fixed income. Bonds have really not been favorable, probably for a while now, and mostly due to the fact that interest rates have been just so low, and bonds are definitely tied to interest rates. But now interest rates are starting to move. We've seen a couple of increases in 2018. The projection is for at least two more to finish out 2018, and possibly one or two in 2019. What a lot of people don't understand is there's an opposite effect and correlation between rising interest rates and fixed income or bond prices. So this slide will show us the impact of a 1% rise in interest rates. And what happens is it's like a seesaw. And the longer-termed bonds, and they're called higher duration, will feel more impact by a 1% rise in interest rates. And they use 1% just to kind of get these numbers. But we've already seen at least two increases in the last year and a half, with two more to go and possibly one in 2019. So there's definitely a 1% rise on the horizon between what's happened and what's going to come forward. And here is the kind of the adverse effect on bonds. So you could see these are on the government side, U.S. Treasuries, TIPS, which are Treasury inflation protected securities, the 10 and the 30 years. So the higher the duration, usually tied to the maturity. So the longer the maturity, look at what happens to these bond values. So 1% increase in rates, you can expect a 30-year U.S. Treasury to decline 16.9%. And so one of the fears that I have for consumers or investors out there is if you're buying longer-term bonds because you think they're safe, you should probably take a look at the duration and make sure that you understand that correlation, that the opposite correlation between rising interest rates and values on these longer-term bonds. On kind of like the corporate side, so we've got convertibles, floating rate, U.S. high yield, mortgage-backed securities. There's kind of the U.S. aggregate bond rate, investment-grade corporates, and munis. So we've shied away from these types of bonds, trying to not have too much of our client money invested. Convertibles and floating rate and U.S. high yield are the only three categories that really would be able to withstand a 1% rise in interest rates based on just a historical look at rising interest rates and what happens to these different types of bonds. So just a snapshot of what's to come if rates keep rising. Okay. So jumping over, so we talked about the United States being kind of at fair value. That does, lead us to discuss what are some other opportunities out there. Should we be completely in the United States invested in these large, mid, small value growth companies? And so this chart shows, if you go back to, if you remember the very first slide, the S&P 500 is this gray bar. And going back to 1997, the ups and downs, et cetera, here's your 16.5 current PE ratio. And the other line is the ACWI ex-USA. So it's the all-country world index minus the United States. In general, you'll see that the ACWI ex-USA lags the United States, which is no surprise. So when the U.S. is trending in upward fashion, the rest of the world kind of follows suit. And then obviously when things go south for the U.S., does so for the rest of the world. And we see this trend kind of developing up until about 2015, right about here. And the U.S. went through kind of like a plateau period where the S&P was just flat for a little bit. 2015, I believe it was flat. And the rest of the world kind of went through a little bit of a mini recession and downturn. And then we picked back up and just kept going right after that. But it took a little while for the ACWI to turn around right until about 2017. And so you can see that they're just starting to turn around after this pause here, whereas we've been on this since 2000 and probably 16. So we're on year 2 or 2.5, and the rest of the world is just, on year 1. So also looking at besides just the trends, looking at the P/E ratio, so it's 16.5 here on the S&P 500 versus the ACWI at 13.2. It does show that there's a little bit more value in the rest of the world in terms of investing outside of the U.S. And also taking a look at, if you compare the S&P 500 again to this 20-year average, 15.9, we're at 16.5 currently. But the ACWI historically is at 14.3 on a 20-year average and currently at 13.2. So it does look like on the international side, there's still a little bit more room and probably a little bit more value if you're just looking simply at valuations. So then we can break it down and take a look at different segments of the international markets, right? It's not just one part, right? You can go into different categories and regions throughout the planet. So this chart breaks it down on the right-hand side here. The PE range for each particular region. So here's the United States. PE ratio was as low as 10 on a 25-year range, high as almost 25 on a 25-year range, and currently, which is the blue diamond, where it sits currently. And the purple line shows us the 25-year average. So here are the developed markets. So here's the range, and here's the 25-year average, and it's currently just below its 25-year average. In Europe, also currently slightly below its 25-year average. Japan is a really interesting case, which has to do with essentially Japan struggling to figure out how to turn their economy around. And Prime Minister Abe, who's known for Abenomics, turned around Japan. But they've really struggled for almost a decade between unemployment, a financial system that was disrupted severely. And so their valuations are very, very attractive, but we do have to keep it in context that, they're coming out of some difficult, called the lost decade. If you're interested in doing some research on that, it's kind of an interesting case study on a country that went from really, really good times to tough times for over a decade. And then emerging markets as well, you can see slightly below. So you can kind of see on an overall, outside of the U.S., between the developed markets, Europe, Japan, and emerging, there seems to be some value there based on just the valuations on a 25-year average. Okay, manufacturing, just a quick slide to show. So here's a heat map for the Global Purchasing Managers Index for manufacturing. It's on a quarterly basis. And the thing that I kind of look at is just the overall, I let my eye catch the colors. And so here from this point up is like the developed world. And you can kind of see when you strip out 2008 with the crisis, but you can kind of see that there was green, moved into a little bit of red here. And here's the U.S., this line right up here. Manufacturing has been pretty strong all the way through. And besides that, in the U.S., it really has picked up. Look at all the green here. So between Canada, Japan, UK, the Euro area, Germany, France, Italy, they're all kind of trending out of this yellow into this green. And then if you remember, I talked about how kind of like the rest of the world follows suit after the U.S. Here's our emerging markets. So they were, going through rough patch in 2014, 15, 16, when kind of we were pulling out of it, and developed world was as well. And now they're starting to show some green here. Again, following us, where we've been in this period of good manufacturing since probably about, it was strong here through 13, 14, 15, got a little light. But again, just looking at the colors, the emerging markets are kind of coming through to follow us as we went through our period. Okay, and inflation. This is interesting because obviously we've had little to no inflation going to 2012, 13, 14, 15. This was a little bit of a scary period because there was some signs of deflation, and deflation is probably, depending on which economist you talk to, a scarier scenario than high inflationary periods. But so we really have had no inflation to speak of, and it just recently has shown signs of picking up here in 2017. We can kind of see the color is jumping up a little bit, and not just in the U.S., but on the developed side as well, developed country side. And then again, looking at just the colors and the coloration patterns, you can kind of see that, removing a couple of these like Brazil, Mexico, and Russia, you can kind of see that the emerging markets have had very, very low inflation and inflationary periods, and they're here where we were probably about 2015 and 16. So they're coming out of a low inflationary period and probably trending towards this that we're going through as well. Inflation is tied to commodities, and I'm going to pull up a slide to show different asset classes. So here's my commodity slide. So global commodities, the valuations are scored on what's called a Z-score, and a Z-score is centered around 0. So when a price of a commodity is a positive or right of 0, it's historically expensive to buy based on a 10-year average. And when you have a negative Z-score, it means that it's cheap to buy or own relative to history. So you can kind of see that on a Z-score level, almost all of these commodities are still to the left of 0 in negative Z-score range. But what's interesting is now I'll pull up my December 31st and jump over to slide number 58, I think. Yep. So when you compare the two, you can definitely see that commodity prices have started to shift. And just looking at the overall Bloomberg Commodity Index, we're currently at 85.39. Going back to 2000 and December 31st is slightly higher at 88.17, but you can kind of see that, so even though the overall average has dropped just slightly, a lot of these are trending to the right and starting to become a little bit more expensive, which again is tied to inflation. And commodities, going back, I'll go back to my asset class chart. So this chart shows me going back to 2003, Let's see, so this will be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Well, this is not. So 9. Of the 9 major asset classes in each year, you can see the best one and what percentage it returned, and also the worst one. And going through, you can kind of see that there's a lot of ebb and flow. So here's your small caps. They're in orange. So some years are very good. They trend down, they trend up, trend down, trend up, trend sideways. And that kind of is almost, you can kind of say it with broad strokes that they follow kind of in these patterns. Some years are great. Here are REITs. So here's real estate investment trusts. They were great here. Then they trended down, trended up, trended all the way down in 2007, as we remember. But again, looking through commodities, remember that slide that I showed you. So this would be 13, 14, 15. So 2013, 14, 15, again, very little inflation, if any, here in the United States. And so it's no surprise that commodities have really not performed very well, whereas usually we were adding probably about a few percentage points to each client portfolio, depending on what the objective was, just as a hedge against inflation. Commodities really suffered and have not done very well over a long period of time, but they are kind of trending back up. And in 2016, this was the only year that they showed some positive return. But we are watching this closely as inflation ticks back up. Commodity prices are rising, and so adding this asset class back is something that we're doing actively with our clients. Okay, so that kind of summarizes it. So again, it was just a quick overview of where we see things and just a snapshot just to keep things in perspective for investors, and wanted to end on that. Obviously, with all the disclosures that I have to give, it's important to make sure that you talk to your financial professional and look at different aspects of your risk tolerance as well as objective and time horizon to make sure that your investments meet those. So that's it for now. If anybody has any questions or would like to contact me, I'm always open to discussing some of this cool data stuff that I look at every day. I'm happy to talk and engage in a conversation. Greg Kojak, you can find me at LincolnParkFinancial.com and Greg at LincolnParkFinancial.com, 773-572-6455. Thank you for listening, and tune in again for the next version. Thank you. Bye.